Ladies and gentlemen of the crypto space, we're live on a Monday, January 9th at 11:52 a.m. Just got off a 2-hour phone call. I'm going to do my best to present some sort of a coherent story today. Entry is the ultimate burden, jumping on a moving train. I compare it in my mind to the same chicken and the egg that everyone encounters with employment. Everyone knows from their own experience and from stories that to get employment you need experience. In most regards, experience trumps actual credentials. Experience is credentials. Experience is superior to credentials. So you need the experience to get the job, and how else do you get experience without getting the job? So it's a matter of the traditional chicken and the egg problem. So that's traditional employment. So why is ownership positions? It's really ownership. I like the way Buffett thinks. If you own stock, you own a company, but we take it further than that. If you own many things, if you own a business, that's meaningful. So how do you how do you digest this reality of chicken and the egg? How do you gain experience with an entry without actually taking entries? It's just like, how do you get a job that requires experience without getting a job to get the experience? So that's a brief little topic that came to mind as I tried to put together a quick stream for you guys. Mostly today will be a Q&A. I'm more than happy to talk at length, answer everyone's questions. But an entry is the biggest burden that we have to deal with. Because, look, people that have positions from 2014, 2011, mid 2000s. I mean, you have mid 2000s, you weren't in crypto, but obviously 2011, there's people in crypto, small contingent of parties at the time. But 2014, 15, 16, plenty of people in crypto. And if you have entries at those prices, there's an argument to say, yeah, sure, you could capitalize on the volatility, which is, trading. You want to sell the top. There's a massive 80, 90% decrease in price point on Bitcoin, Ethereum from the most previous cycles, 3, 4, 5 year time horizon. But obviously, anyone that bought Ethereum at $3, do they have the luxury of not having to give a shit if it went from 3,000, whatever the hell the all-time high was, to where it is now, 1,000? $3 to 1,000 is extraordinary. So it depends on the person they are, and do they value the extra effort and time it takes to learn technical analysis to get off the train, only to get on the train again when the train slows down, to capitalize on that volatility. And I fall firmly in the camp of just getting on the right train. And the right train, obviously, we talk about has characteristics of sustainability, is actual infrastructure that has meaning. We speculate has meaning to, the systems which we engage with, and we expect over time more participants to come in because opportunity is available. Maybe it's technological infrastructure for the creation of alternative systems that we talk about in the traditional markets, data storage, identity, so on and so forth, forex, money markets. You see where I'm going with that. And that has a long time horizon. So do you really need to capitalize on the volatility? And I would argue, especially as I get older, it's my 40th birthday in February, that I don't give a shit about the volatility. What I want to find is the right trains. I don't want to be sitting in front of a computer doing technical analysis, of which clearly we have a capacity to do. That's not what I want to do. I just want to own things that have the potential to live up to what I've identified through due diligence as being consistent with productive assets. And in that instance, you don't have to get off the train. So how do you get an entry in those things? Just because I pose the question as the premise for the stream doesn't mean I have an answer to the question. How did we get to where we are? How did relatively successful investors get to where they are? Everyone will have a story. I'll have a story of how I got to where I am. Doesn't mean just telling the story implies it can be duplicated. In many regards, that's the risk of acquiring the experience. The experience of being a successful investor requires at first being an unsuccessful investor until you buy the right thing and you're like, oh, that's why it was the right thing. Oh, let me look for things that are comparable to that right thing. And then that's how you build a narrative and a thesis. And if you're consistent with your thesis, you're going to be more likely to be right over time than wrong. And that's like the foundation for entries and things, especially new things where you take in an increased exposure to risk. But if the new thing is brand new and there's risk and who's the actors involved, but you have a methodology for assessing who's involved, why they're involved, what are their intentions, what is the potential outcome of their involvement? Is it malicious intent or is it, opportunistic, capitalistic intent? Are interests aligned? The potential to disrupt incumbents is a great reason for interest to be aligned between sharks and little guppies or lions and bunnies. If you got a herd of elephants or angry elephants, this is probably I question whether this is a decent analogy. But if you have a herd of angry elephants that are devastating the savannah, and you got lions and bunnies that are like, no, we don't like this. The lions are going to go after the elephants. The bunnies go in, and clearly the bunnies aren't going to do much against the elephants. But the point being, that's a time when the lions aren't necessarily going after the bunnies. The lions are doing what they're doing, which is getting rid of a devastating herd of elephants, and that's to the benefit of the bunnies. So what happens is, in that scenario, the interests of the predator and the traditional or the average prey become aligned. Now the question there is, for how long are those interests aligned? So this plays a meaningful role in picking entries, seeing whether interests are aligned between predators and prey. I guess that's a good synopsis of what I was thinking when I wrote the title of the stream. Otherwise, we're looking at the DXY. So right now, I'm quite comfortable. It's nice to get a smile when looking at the markets for the first time in a bit. Obviously, everyone sees the relative appreciation of assets this morning. And that's predominantly the inverse correlation with the dollar. And it's not the dollar. There's more to the story. It's liquidity. It's all about liquidity. But what is liquidity? Liquidity is free capital available to speculate, take on risk, take on positions, take on speculative activity to outperform risk-free. And there's plenty of ways to outperform risk-free. Technology, innovation, maybe a new mine is coming online and they're going to be very productive of a critical rare earth material. So even in the tightest of liquidity times or the most fearful of times, there's always a place to deploy capital to outperform, risk-free, which is what, 4.8%? I mean, come on. Yes, and this obviously is like assessing the size of the actor. Absolutely massive actor with $100 billion doesn't really give a shit about outperforming if they get in 4.7% on 6 months, 4.8% on 6 months bonds. Who cares? That's a massive amount of income. Or maybe they do. Maybe they have a family office and they diversify the portfolio, and they have some allocations to things that speculate to significantly outperform. But that's the type of market we're in. We're always comparing to the risk-free rate, 4.843%. What an extraordinary number. So this is putting definitely a different perspective into a lot of minds when they think about engaging with the markets. I mean, corporations are trying to raise capital. They're going to have to offer a fair amount more than 5% in order to garner attention. And then the question becomes, are these corporations actually capable of servicing a debt interest payment of 7, 8, 9, 10%? Are they even able to raise capital compared to 4.83% risk-free? There's no risk. The government prints money. You got to get paid on your bonds. So that's what drains the liquidity. The high rate of interest on risk-free takes the interest out of taking risk and places it into a situation where, risk-free is much more chosen. But that still does not completely remove liquidity from chasing risk. Smaller actors. A larger actor is more inclined to take risk-free. A moderate actor, they diversify, they have some risk-free, they're taking speculative risk, but what happens is, as decrease in liquidity occurs, those speculated risks are much more concentrated, much more isolated, much less broad, much more well thought out, much more due diligence. The smallest actors are probably still exposed to a great deal of risk. The smaller actors tend to not be so constructive in their deployment of due diligence, so they're still exposed to risk, even though because they don't have a capacity to expose to risk-free. $10,000 exposing to risk-free, you're getting nowhere slowly, because 4.8% risk-free is still not outperforming consumer price inflation, real consumer price inflation, not the numerical value of whatever it is, 7, 8, 9%. When you see cost of goods go up 20%, the specific items that I purchased 10, 20, 30%, that now you're talking about the real consumer price inflation, because you have to come up with that actual amount of capital difference. So those, which is actually the majority, would that be the vast majority? Average Jane and Joe? So there's trillions of dollars of capital available, and maybe after things are blown up and 90% down, 95% down, 99% down, that is enticing enough to draw in capital. And that's what I talk about. Why would capital come in to something 95, 99% down? Because maybe it is freaking real. Maybe there's something systemic there. Maybe it's very, very innovative. And it wasn't just bullshit, as detractors will point out. Yes, I agree. The vast majority is absolute garbage bullshit. But what the hell have we been doing here the last couple of years? Identifying the not bullshit. The dozen and a half, 2 dozen protocols and systems that actually have characteristics of survivability, actually have characteristics of an emerging market, and have been able to capture and continue to attract capital inflow because they offer something, they sell something, maybe something's commoditized, maybe inflation has been packaged, and it's a sellable product. It's meaningful. And, these are things that potentially give rise to a reason to jump on the train. Now, obviously, jumping on the train earlier rather than later has increased ROI. But there's no harm in jumping on the train later. What's pertinent is the characteristics, the things we talk about. Survivability. Is it an actual meaningful system? Can it disrupt an incumbent? Can it change the way people behave into the future? And that is what attracts more capital inflow into the future. So there's reasons to jump on the train, being very speculative, very early. And depending on one's skill set, you could actually decrease the risk profile by extending significant due diligence. Now, obviously, if you're jumping on the train later, you have more time to deploy due diligence, and you have lendiness. The longer a technology exists, the more likely it is to continue to exist. So you have built-in survivability that is viewable, observable, digestible, even anecdotally. If something was built in 2017 and it still exists and it's actually grown, you're anecdotally observing, oh, that's probably a good thing. And it's more likely than less to survive. And that's things like Bitcoin, Ethereum, amongst other protocols, the few that have survived since the last cycle. So most people anecdotally observe those characteristics. And I would argue, and I would express to everyone that listens to me, it's imperative to explicitly observe those characteristics. Know that you're looking for characteristics of survivability and utility, and not just, assume anecdotally that that's what you want to deploy capital to. Know that why you're deploying capital to something is because it survived, and that is one of the most meaningful things when contemplating an allocation. Dare we say survived and was productive the entire time? Oh, these productive assets, quite extraordinary. Let's take a look at DeFi Llama and see how stablecoins are doing. Minus 0.58%, so it's a slightly, marginally negative sum game. And we've talked about this topic on other streams. Won't digress, won't digress. Let's see how Curve's doing. Oh, okay. 67.5 cents this morning. All right, well, this is interesting. This has shown characteristics of survivability. It's shown consistent capacity to be productive. It's drawing in capital in a tightened liquidity market. Now, bear in mind, it's still below some meaningful resistance. This is a heck of a region of congestion. So there's always an uphill battle. But that's what I'm looking at with regard to the DXY. The DXY is pushing below the TWAP on the monthly, but it needs to really push below that bottom green line. That bottom green line is 2020 highs, the spike high for the dollar. Push below there, and you have the freeing up of a significant amount of liquidity internationally. It relieves the debt servicing burden. Less foreign currency is required to service dollar-denominated debt, which frees up capital to maybe make more capital so that you can be prepared when their currency is weaker, and now they have made more money so they can service their debt better. Anyway, so whenever someone feels pressured to come up with more money, they speculate. They take on additional risk, open a business, buy a business. So everyone is always thinking about their debt servicing obligations. And if there's an opportunity to make capital, that's what encourages the risk appetite when liquidity is available. So when this value on this screen goes down, Japan and the euro, it frees up a meaningful amount of capital. Having just gone through an entire year of a burden servicing dollar-denominated debt. So when the dollar comes down and the foreign currencies are strengthening, it gives them more ammunition. They're like, oh, we just had a goddamn burden of a year. Maybe we should figure out how to make some money so we could be better prepared to service our dollar-denominated debts. So that's why when the dollar comes down, capital is deployed. People are hungry, and now they finally have an opportunity to use their available capital to make some additional capital. That's the power of this little line, this little chart. Quite extraordinary when you really dig into the extent of the information this simple chart provides. So, a little bit of support on 2020 highs. You can see the wick there. Still meaningfully below the TWAP. 22 days left on the monthly. Let's go over the weekly real quick. Support expression. It's a solid double top in 2020 on the weekly. Solid double top. And this is going to take some time. Bit of a structure of a low shoulder, head and shoulders. Those are some tiny shoulders. I don't know, maybe. Does look weak. Maybe we see resistance hold as resistance for the 2017 high, which comes back here. Top green line. 2017 high holding as resistance, and for another run at the 2020 high, that would be very interesting to put in resistance holding resistance, which basically invalidates the entirety of the May 22 move above these previous highs. It means that resistance was never broken. It's an invalidation. Quite interesting. Bear in mind, we're also right around the midline of this channel. It's a decent channel, decent structure. Maybe the structure's a little better on the daily. All right, I don't know where the bottom of this structure went. I used to have good structure on this channel, but excuse me, top line has 2 touch points. So that was meaningful resistance, clearly overextended. But it'd be nice if it comes down, the 100, 102s, the odds are it's going to come down quite a bit further, maybe to 99, 100 SMA on the weekly. Oof, 200 SMA on the monthly is at 88. Look at that trend. This is barely a blip. The monthly chart really gives you the perspective that's the most important to consider. Look at that. All of that of 2020 to 2022 dollar move is just a little blip from 86 200 SMA to 88. 4 points on the SMA. That's how slow the monthly chart moves. That's why it really takes 6 months, a year, 2 years, 3 years, a couple year time horizon to really digest the directionality of the market. But if we breach through 2020 highs and don't hold the TWAP as support, 50 SMA on the monthly is down at 97. So we got a tightened liquidity environment, but really what you see is interesting risk assets that have a potential to allow an individual to actually outperform risk-free meaningfully. Um, Historically, you see it in the inverse move of the dollar versus the euro and the yen. And that's exactly what we saw here for our previous bullish cycles, 16 to 18. I mean, the end of 18 to 19 was the most painful period was a painful period for crypto markets. And it literally just shows on the dollar chart. Look at this other period, March 2020, dollar topped to the bottom, December 20. Yeah, if you remember December and 20, things started to fall apart about December, earlier than December. But it started to end in January, which is basically right here. Look, you had more risk on because the TWAP held as resistance, and you had another rip to the upside heading into summer. This actually makes perfect sense from a risk asset capital flow perspective. And then everything started to fall apart, started to get weak. I think, this is not a direct inverse correlation, but the point is this is meaningful. Once it breached the TWAP to the upside, let's say on the monthly, that's when you got to start watching. That's when you got to really start looking at risk asset allocation and saying, why is someone going to deploy to risk asset if debt servicing costs are going to significantly increase abroad? That means they're going to need their capital and they're going to sell basically everything that is not bolted down to the ground in order to service their debt obligations. And obviously, the easiest things to be sold will be sold, the most liquid things. Are properties liquid? Sure. Stocks, bonds are a click of a button away to sell. And now crypto. So that's why these instruments are sold when cash is desperately needed to maintain solvency. A company that has Bitcoin on the books, the Bitcoin mining companies and Bitcoin and the dollar's going up, that means they need more dollars, but maybe Bitcoin stagnated and it's not increasing in price. So the debt servicing cost is going up, but the income, the dollar denominated income of the organization isn't going up. So what do they have to do in order to service the monthly debt obligation? They're going to have to liquidate Bitcoin, which ultimately drives the depreciation of risk assets as the dollar appreciates. So I really look at the crypto markets as an emerging market, as a foreign currency. It has that type of relationship with dollar strength. Albeit I don't really think of them as currencies, but that's another story. It's a nuanced topic to discuss. This will be nice if this falls through. It'll give some support to the risk markets as tightened liquidity conditions persist, and the risk-free rate significantly increases the cost to carry debt loads. Gazik is in the house right on time. Hello, Kaysen, Killis, good morning. Bill Clinton's in the house. Yes, sir, yes, sir. Caught the stream live. Love to see it. It's a pleasure. Raoul's in the house. Tapsy, one curious view. CPI down, surprise on the way. Well, what is a surprise? CPI is a lagging indicator at best. It's definitely not a forward-looking indicator, I guess, in regards. It's manufacturing. The manufacturing and then those ratings, you know, those are the most forward-looking indicators. And I like to look at the dollar because I think the dollar is basically just real time. It's a real time presentation of available liquidity. So you can look at forward-looking indicators to speculate, but I like currency to really get a sense of available liquidity. So what do bonds tell you about liquidity? I mean, they'll tell you when there's a risk-off event. I mean, that's historically what we've seen, but we haven't seen that in quite some time. We haven't seen risk off for years at this point, where bonds rip to the upside price point and yields basically collapse. But with regard to liquidity, the risk-free rate dries up liquidity at the top end. The wealthy people don't give a shit about taking risk when you get in 4.8% on your money risk-free. So that dries up liquidity in that regard. But it doesn't really dry up liquidity in the speculation end, the small retail actor, because risk-free doesn't influence them at all. Consumer price inflation influences them because that dries up their available liquidity. But when people are backed against the wall, they tend to speculate. So if there's a couple of $1 trillion worth of cash, I think, still available by the general public. They're burning through it. So decreased liquidity. Decreased liquidity environment does not entail risk assets can't outperform for even a brief period of time. Because this chart depicts that availability of capital globally. This is a global global liquidity chart, which is quite extraordinary because most people think about the dollar and they're like, oh, it's just the dollar. No, the dollar basically controls global available liquidity. Interesting. Have you bought anything new after this big pump? I bought. I got ever since Solidly came online. I basically I burned assets on Phantom and they got reinflated on Ethereum, which is very nice. I think I about doubled that position, give or take. That's about it. I think that's a perfect example of a protocol that has predators and prey aligned because there's a bigger target. And I think they have a chance at taking on Uniswap. I don't think they're going to be able to take on Curve. Curve has very different considerations. But from a Uniswap perspective, I think they have a chance because really all they have to do is get the flywheel in motion, which draws in capital inflow. Once you get the appreciation of the assets, Solidity is a very different tokenomics than other incentive systems or protocols that have incentive systems built in. It's a low liquidity tokenomic structure. It's designed to be low emissions. There's going to be a period of time where the emissions ramp, but they come down really quick, which is going to be quite interesting because the emissions ramping is going to be high yield, and that's just going to draw a frenzy of liquidity over. But they ramp over, I think, like 4, 8, 12 weeks. It's fairly, long-term, but macro, relatively short-term ramp period, but they come down real quick, and then they just keep going down every week over week. So the entire protocol is designed around token scarcity and focusing on appreciation of the asset to ramp incentivized returns for LP deposits. And the largest actors in the room are completely incentivized to prop the price, to encourage the flywheel activity. There's literally, because I think if my ideology has spread even a little bit through the crypto space, there's actors out there that hopefully think, I don't give a shit about massive capital gains. All I want is to get a protocol off the ground that's paying out X amount of dollars on a weekly basis. So there is actually reason to think that the largest of predators can be very aligned with relatively small actors. Come on, it's a big deal. You disrupt Uniswap and you control a percent of the cash flow of a protocol that size. So it's a very interesting potentiality. I've been very prudent with capital deployment. I haven't done anything basically the majority of 2022 except capitalize, extract dollars. So this was probably one of only two protocols we talked about over the last months is basically this and tapioca. And it looks like this one's playing out pretty much as expected. I like that we've heard Andre talk recently. You know, a lot of people get the wrong impression of him, and he's a strategist, definitely not a dev. History in what, DevOps, I think he said. But he's a strategist, and the tokenomics is quite well thought out on this one. Why? Because it draws on precedence. Anything that draws on precedence is iterative. It means they're taking the best of the best that was built, that worked, and they're making it better. You don't have to reinvent the wheel. So that's a strong position to be in. It increases the likelihood of success, creating something meaningful. So that was my rationale. That was my logic, and relatively small position. I think it was like 2%, give or take. And that's cool, you know. There's no reason to watch it. The largest actors are there. That's what's interesting about it. The largest actors in the room, folks like Roosh, he's completely incentivized to stick with it. Why? Because you have to if you want to disrupt Uniswap, and the potential is there. But bear in mind, obviously, if there's a failure on the table, that's a large actor that could liquidate real quick. So there's always a risk profile. But you know, the lions are only aligned with the bunnies as long as it serves the interest of the lions. But as soon as the alignment of interest stops, bunnies look kind of tasty. So if you think about these analogies, this helps you size an allocation. What kind of risk are you taking? And the potential is big. Uniswap's a big target. The risk is also there because if the lion turns on the bunny, ooh, that bunny looks kind of yummy. So that I hope that helps, Shisha. Snoke, keep it up, Captain. You're welcome. I try my best. Obviously, interesting times. But I'll be here through thick and thin. This bear, there's no leaving. This is what we do. This is the perfect time to digest what the hell is going on in the market. This is when you prepare for the market to be good. You have to understand why markets are bad. If you don't understand why markets are good and bad, you can't navigate markets. There's no turning around. There's no fear. There's only better and better. Understanding macro, understanding liquidity, understanding these capital flows, the emerging market capital flow cycles. And that's how you do well over the decades. Hilda's in the house. We are survivors. That's the way to do it. Yes, indeed. Bear market rally is something sustainable. That's a good one. Well, the market tells us whether it's sustainable or not. So by definition, this is a bear market rally. If the dollar reverses to the upside and holds support on 2020 highs or the TWAP, that's going to really pull the rug out real quick. So obviously, NASDAQ is ripping today as well. I've been following NASDAQ because it's basically sitting right on trend as well as the monthly 50 SMA. So this is the type of market that you have great price volatility. Why? Because if there's any sign of liquidity issues, the rug gets pulled on everything. The rug gets pulled on risk because people are deploying right now to risk. Why? Because these are the early folks. These are the folks that have capital. They're early and they smell the dollar. They smell the pressure coming off the dollar, which they know releases liquidity globally. And we know what the hell is going on around the world globally. There's a huge amount of capital. They're printing capital all over the place. So that's why there's a good bullish impulse here. These are the early folks that are speculating. But this thing reverses to the upside. This entire move to the upside that you've seen so far is going to retrace real quick. It'll retrace real quick, and it'll probably retrace lower. So that's the deal with regard to sustainable versus bear market rally. Certainly, it's a bear market rally. It's a rally in a bear market. Sustainability is more about the liquidity and the dollar's effect on global liquidity. Mike, I think Andre is best as an idea man and prototyping. He needs to learn to hand the stuff over to those that can deliver. Yes. From what I see, the code implementation for Solidly and Monolith is quite impressive. It is functioning as expected. Is that a low bar? No, I think that's meaningful. We've seen the emission schedule, we see the APRs, and they're very reasonable, which is very consistent with the original design documentation that Andre put forward. So basically, that's my impression thus far. It is the behavior of the protocol thus far is expressing the original intent of what Andre wanted. Clearly, what he deployed didn't even get close. But this very much looks like it's living up to expectations. That's right, Mike. Chris, curve quiet pump today. Fees on GMX today. Oh yeah, the volume's been wild. I mean, even volume on curve. When I get $1,000 a week on curve, I'm quite the happy camper. So curve's been doing well. I'm happy. GMX, great protocol. Synthetics, optimism, great protocol. Volume and options and derivatives, great. That's lovely. We have our target of interest. Now, it's not mutually exclusive. I have interest in all that stuff, but I focus on Forex rather than synthetics and derivatives and options. I like the primitives. I like the concept of large actors exchanging $10 million, $100 million worth of stablecoins, and obviously the market. They do that, but the market has a ways to grow. Why not billion-dollar transactions? $10 billion transactions. So that's 5, 10, 15 years. I would say more likely than less. And they're not going to do that through a derivatives protocol. They're going to do that through the most Lindy, lowest level, Ethereum native because of the finality, and using stablecoins that are the most trusted with regard to regulatory oversight. With what Circle is doing now, it's pretty interesting the direction they're heading. Their integration or coordination with BlackRock is quite intriguing. So I want to capture that volatility, those exchanges. Anyway, Aura's getting hammered. Let's take a look real quick. Poor Aura. They have one of the most dynamic governance forums I've ever seen. Some great folks over in our forum that keep us apprised of what the hell is going on with Aura. So, I like Aura. Aura is an iterative implementation along the lines of Convex, as Balancer is to Curve, and that's meaningful. Superior tokenomics. Now, always remember, superior technology, superior tokenomics does not invalidate the predecessor. It is quite often and throughout history we see examples of inferior technology remaining overwhelmingly dominant, just period, into the future. So that is important to understand from an expectation standpoint. Disruption of the status quo is near impossible when the status quo itself is an ongoing disruption. Tongue twisters today. Always remember that. So this is cool. And a lot of folks on the forum know I took off a piece for Aura. It's quite productive. I would love to see, dollar per VL Aura stay around 4.5, 5, 6 cents. I wouldn't mind the $4,000 every 2 weeks. I'd really appreciate that, please, Aura. That'd be very nice. 4.5 cents. Come on, baby, 4.5 cents. Pay for the votes, boys and girls. Protocols, third-party actors paying for votes, renting vote weight. So I'd like these numbers to stay up. This is a relatively small position in the portfolio, all things considered. But I have a high opinion of what they built from a tokenomic standpoint. I happen to have a higher opinion of what may play out with Solidly from a tokenomic standpoint. What has been done thus far, I can't knock ever on what has been done thus far, but folks may originally remember how I discussed what Andre was talking about, and he was onto something quite meaningful with dilution protection. So what we're doing in DeFi is experimenting with monetary policy. Do you favor new users? Do you favor incumbents? Do you favor large actors? Do you give opportunity to small actors? And that is the whole assessment we make of protocols. Who gets who gets incentivized? Who is lent the most favor? Who has opportunity? Where are interest and where are interests aligned? And that is the assessment that we make in evaluating existing and new protocols alike. I will not find love on this new dating site. Thank you, PAS36. I've never needed a moderator. Can I moderate that? Put user in timeout. You are in timeout. It's the first time I ever did that. K's and I know. I don't mind either. What are you going to do? That's why I like these locked assets. If you're speculating on the potential for a protocol to actually reach critical mass with regard to survivability, you lock the shit. And if it goes negative, it goes sideways, it doesn't survive, it doesn't survive. If it survives, that changes everything. So that's the consideration that goes through my mind. Chris, you said $1,000 week on Curve. Can you say how many ballpark Curve would need to be staked without exposing yourself? A lot. A lot, my friend. Um, you need a lot. You need a lot to get $1,000. But bear in mind, it's not the size of the position because it's the well here you see it right here. Come on, but it's the volume. So look on my calculation is for a $683,000 week protocol, and I have X amount that produced X amount per week. You can extrapolate from there. So if it's $6.8 million a week, then it's $10,000 a week in stablecoin income. $60 million a week, and I'm making $100,000 a week. So there's the speculation, and there's the proportionality. So you also have to factor in the size of the position. A Curve is an uphill battle because it is the oldest, and there's a lot of tokens available. So this comes back to the original point of the stream, entries. There's more opportunity when you're earlier with an increased risk profile. There's less opportunity when you're later with a decreased risk profile. I believe that's the nature with all investments. And, we could say that that's disappointing, frustrating, but it is what it is, and it's important to understand that it is what it is, and we say it is what it is. And as long as folks know the reality of what they're engaging in, they understand the extent of due diligence, or they even understand how to deploy due diligence properly, then we could try to outperform. You know who we're outperforming? A person that just gets up and goes to work and comes home and drinks beer and watches football and then the next day does it again. No knock against beer and football. I enjoy that as well. But the amount of effort required to assess whether something is of systemic significance, a meaningful thing to purchase, that's some serious work. What disturbs me the most about bullish markets, when people buy Hex and Doge, is they think this shit is easy. They think that this is supposed to be easy. They're seeing something that's incredible, and it was easy. Fuck no. Nothing good comes from money that was made easy, because you learned nothing. Good things come when the money is earned the hard way, from extensive due diligence and likely a shitload of losses. How many in here have lost a shitload of capital? Hi. Lost a shitload. Because I've lost, I've been taught. I've learned how to retain capital. I've learned how to allocate capital to win more than lose. So I've learned how to survive because I've lost. Hope that helps. Quantified morning cap been catching sooner. Some of the bear. Wanted to drop in and wish you well. Thanks for carrying the candle of rationality through the dark. This need the rationality more than ever. But you're very welcome. Do the best I can. Bill, one more question. What's your update on tapioca? Nothing. You don't. There's no way to assess anything until launch. And launch, you go on Etherscan. Launch, you go on Discord. Launch, you assess who the large actors are, who owns the majority of assets in circulation. You assess emissions, you assess consumption, you assess the potential for capital inflow, you assess the incentives that are deployed to drive capital inflow, you assess the marketing activities to drive capital inflow. So everything is an incentive system. Very, very few protocols will get off the ground organically. High APR numbers are historically the most successful incentive system to drive capital inflow, but it's not sustainable. So the more innovative of protocols are thinking about how to drive the capital inflow in a sustainable way. So we'll see. You will not know at all until it's deployed. And then you're scrambling to look through the data to see almost hopefully in real time who's consuming the protocol, what are their intentions, how are they coordinating, and intentions. What's their intent and where is the intents aligned? And that's what makes the difference in taking a position, jumping aboard the train, and saying, holy shit, I'm out of here, and jumping off the train while it's going 60 miles an hour and taking a couple of bruises along the way. So that's a good metaphor, actually. Because you're looking at Etherscan, you're seeing the actors, how large they are, how they're colluding and coordinating. If a large actor wants to capitalize, it's not going to be pretty for anything new getting off the ground. So hope that helps. Kaizen tapioca still in testing. Yeah, time is irrelevant. It'll come when it comes. I'm hopeful. I think I have a good feeling. But that doesn't mean shit. The things we will know only once they launch. Building a decent sized curve position, that's why I asked the question. Thank you. Yeah, it's all proportionality. What's most important is a couple of rules of thumb. If you can't take a position because you don't have a capacity to get an appropriate or desired position size, sometimes it's best to not waste the effort. Because if you're going to spend a year saving and buying curve, and at the end of the day it's only going to produce $1,000 a year, it's not worth the effort. Now you're doing like a cost-benefit analysis. In that instance, there's much more benefit to pursuing capital gains, which means waiting for more favorable liquidity conditions, sharpening your technical analysis skill set, such that you can capitalize when there's a lot of rabbits in the field. So that's meaningful. But I appreciate what you say. I, just like you, or admire curve, my position size. I'm very grateful. Allows me to be very complacent with it, especially considering the lock. But just know that it takes a fair amount of capital to have leverage, carry weight in the amount of cash flow that it produces. I don't think it's necessarily an uphill battle. It's been quite productive from a vote rental standpoint, as well as from a transaction fee standpoint. Now, we obviously know it has shortcomings. We know there's deficiencies, and they were improved upon, iterated upon by Aura and Balancer, and further by Solidly and Monolith, and Velodrome and all that. The original Solidly forks, Solidly V2 is much superior implementation. But just as I said, the best technology does not necessarily disrupt the incumbent. And that's why Curve has, $3.8 billion worth of capitalization. How much do they got? That's an extraordinary number for a protocol to retain during a bear market. I don't know how many folks remember 2018 and 2019 where everything died, and they got $3.94 billion. Okay, okay, I'll make my own assessments. Folks out there that are die-hard detractors, this is an emerging market that has retained $4 billion in a completely draining liquidity environment where 6-month bond yields are 4.843% and the dollar ripped to 114 and there's $4 billion retained this in this emerging market. I'll make my own assessment whether this market has sticky capital. Come on, you tell me a country gets off the ground and capital flows in to that degree and it gets stuck? That's meaningful to me. Expensive tuition fees, if you will. Well said. Curve calculator helps. Problem is curve calculators for incentives on LP positions, and I'm not fond of LP positions. LP positions are for the mega whales. You know, you got $100 million. All right, fine. You have a large curve position. You have $100 million in stable coins, and you juice your returns. That's cool. You might as well do it with convex, but you know that's besides the point. So, but the curve calculator is interesting information, meaningful always. This is part of the due diligence. You use the calculator. You look at the convex LPs. Probably shy away from them, but calculate cost-benefit analysis. What's the potential opportunity? And the smaller the portfolio, you need more concentrated positions. So you have to necessarily turn down positions. I'm going to find that tweet that I wrote. It was a good tweet. I write some good tweets every now and then. I don't know if you guys know that, you know, I write on Twitter some good tweets now and then. Where was it? Let's just find this one tweet. Predatory psychology. The hardest part of engaging a market is seeing an opportunity and being able to identify that the opportunity cannot be taken because of lacking position size. It's disappointing. It's painful. It hurts. It's frustrating. Often perilously ignored, producing results that don't live up to expectations. It's all about expectations. And the second your expectations are not met, it's disappointing. So always remember these things, hopefully. How was your Gods Unchained deck been doing? I love my Gods Unchained deck. Listen, when I drop a Diamond Harvester, folks are like, woo! Every time I drop it, I'm like, woo! It's just cool. So I'm quite fond of my Gods Unchained deck. Where's my Gods Unchained deck? I'll show you guys. Have some fun for a second. That's my beauty. It's a bit of an art, just like Magic the Gathering. Fair amount of low size. Try and increase the speed. Destruction. Armor. Obviously, it's a zombie deck. I opted for the Curse Obelisk. It's faster, because if you could get 2 zombies out rather than 1, even though the 1 Necro is going to give you 2 twos, more destruction, a little bit of protection. These, when I found them, I was like, oh, it's a little bit more destruction? Cool. These are old school. Soul Shatters. A couple of 4s, Decaying Rhino, Pools of Nemesis. This thing's crazy. When you're able to drop 2 or 3 legendaries and you're copying them, that's just wild. Raze, Nether Swarm, Guild Enforcer. And the big boobas. Avatar, Harvester, and Nefiru. Nefiru is just nasty. 3 damage to everything. That's my favorite. And bifurcating. I'm tempted to throw back in Apocalypse. Apocalypse Now. Maybe. The problem is 7. 7 is very hard to get to. So the 6 has done me well. Overall, this deck has served me well over the last couple weeks. Nice balance of speed versus stuff that's on the higher end of the spectrum, the cost spectrum. My man Dominic. I like that game. Chris, would I be right in saying if you stake 1% of all curve on curve for 4 years, you would get 1% of fees? Yes. You get diluted, but yes. Now, bear in mind, I don't really care about the dilution. The directionality I speculate curve is heading, even if you're diluted, the growth over the next 5, 10, 15, 20 years is going to overwhelmingly compensate for any potential dilution that one could be exposed to. That's just my sentiment. It's speculative, and only in hindsight can we ever assess how that plays out. Last couple questions. Raul, question regarding MO solid. Only the position that was locked 1 week will not dilute. So dilution is anti-dilution protections on a weekly basis, which means every successive rebase, it is harder and harder to attain a stronger position in Elmo solid. Yeah, I know. Memes. Elmo solid. So the dilution protection does protect you against other people that are locking after you. You're protected against their diluting effects on your percentage ownership of protocol cash flow. So that's novel. R doesn't have that. Balancer, curve, convex, no one has that dilution protection. So that is a good part of what catches my fancy with regard to an iterative implementation. Now it's very subtle. It's not like it's not an extreme. It's not like it's designed like Olympus or some sort of extravagant, highly inflationary number. It's designed with finesse. We've already seen one rebase, and it looks to be as expected, protective. And that's quite interesting. At least I find that interesting. Late, but you're here. Critical Mass is a good one. This is a long stream today. I got to wrap it up. I got a shitload of work to do. One Curious View. Chris, a pleasure. Thank you all. 12:49 p.m. on a Monday. As always, thank you all for joining me. Tell everyone to subscribe. Folks don't listen. I can't help them, and I would like to help as many people through this bear market as possible. You know the deal. After party on Discord for the most rational community in the entire crypto space. I appreciate everyone in there. I wish you all a good week. Stay safe. Be rational. Make better decisions. We could do that together. I'll see you again on Friday. Peace.